Okay, we'll start now our session on the 101 due diligence. I'd like to introduce the speakers in here. I'll be the moderator. Alan Dickson, partner of Conyers Dill Pearman, about 25 years experience in the sector, in the legal side, and now living in Brazil for the past 2 years. Peter Ijsseling from A&T Fund Service, 14 years experience also in the sector, in the management of funds. And also Peter O'Connell from Conifer Fund Services, also to discuss the same subject. So I think we will start. The objective here for the conversation will be like that each individual will present, their experience. So I think we can start. I don't know what would be the sequence.
I had a few slides. I wonder if we could put them up, and I'll walk you through some of my thoughts on this subject of investment fund due diligence. I don't have a clicker, so we'll have to click through, but this is a very topical subject, I think, for investment funds, particularly coming out of the last few years and the experiences we had with funds and investors in funds trying to determine what their respective rights were vis-a-vis redemptions and liquidations and so on. So the whole topic of investment funds due diligence is a very broad topic. So as the only lawyer on the panel, I'll take a moment and give you a disclaimer that we're just going to try to give you a broad overview. And I would hope that people could just take away from this discussion some high-level ideas about what they should be looking for, either on the asset manager side in getting a fund ready for due diligence, or on the investor side in getting ready to conduct a due diligence. So I approach this by asking some basic questions. Why do due diligence? How do you do due diligence? Who should do it? And where? What jurisdictions do you do it in? For offshore funds, which is my world, I see due diligence as a risk management exercise for investors. A very important risk management exercise for investors, and a very important exercise for managers, because when they're courting prospective investors and they have a new family office or a new prospective investor coming in, I think it bodes well if the fund is well organized and ready for the exercise and anticipates the kinds of questions they're going to be asked. So the why of it is risk management. The how of it, strictly speaking from a legal perspective, the how of due diligence is a bit like going to the dentist. Everyone has to go, but it's not always pleasant. It's a review of constitutional documents. It's a review of the contractual documents with service providers. It's a review of regulatory filings. It's a review of tax structure. It's all these things. And it involves who? A multidisciplinary team. Your accountants need to be involved, the business people, the guys who are actually going to be on the phone doing the trades, coming up with the strategies need to be involved. The lawyers are involved. Everyone is involved. You have a multidisciplinary approach. And where, for the funds that I work with, typically we would have some diagrams a little later I'll show, but there's usually several jurisdictions involved. Starting at the bottom, I think of the bottom being Brazil because I live here. But up above, there's typically a U.S. LLC. There can be an offshore fund. And diligence occurs in all those jurisdictions, and a good due diligence is going to involve players from all those jurisdictions. There are three very important stages of due diligence for me. The entry stage is when a new investor has been identified and they're coming in to find out about you. If my client is a fund manager, we sit together and we talk about what needs to be in the binder and what needs to be on the table when the investor arrives with their lawyers to start talking about and diligencing the structure that's been set up or proposed for a new fund. So the entry on the investor side means finding out as much information as you can about this manager, their track record, the structure they're using, the service providers they're using, the jurisdictions they're using. It involves asking an awful lot of questions. But although those are all entry-level questions, other questions that need to be asked at the entry as well are, what information am I going to be entitled to receive during the life of the investment? How am I going to know how things are going? How do I keep track of this? How often am I going to hear from this fund, and what quality of information will I be receiving? And even more importantly, I think since the 2008-2009 so-called redemption crisis, how do I get out of this fund? I think what we saw during that period was litigation where the perception of fund managers and the perception of investors as to how to exit from a fund did not line up. And so we had a number of very high-profile legal cases run through the courts. One went as high as the UK Privy Council out of the Cayman Islands, debating that very point. And there was a misunderstanding between the fund managers and the investors, a fundamental misunderstanding as to when they would be entitled to receive their money as a creditor from those funds. I think the exit strategy has to be very firmly known up front. And in looking at this, in looking at all of this, you start with the constitutional diligence of the fund. When we start a diligence process, I always say that it's the prime opportunity for an investor to ensure that some fundamentals are enshrined in constitutional documents of the fund, so they become almost non-negotiable items. So things like I have up here on the slide, investment goals, whether they're broad or restricted, the commitment period and term. In one fund we structured, we put a key person event into the constitutional documents because the investor wanted to have access to a particular manager, one individual who had a great track record in a particular industry. And so we added a key person event and into the constitutional documents so that if that person was no longer associated with the manager, it was a automatic redemption event. If there are going to be restrictions on leverage and hedging, that can go into the constitutional documents also. I think it's important that distributions be clearly set out and provided for in the constitutional documents, and also some direction as to who is going to have the right to wind down the fund. That's another business point that was litigated following the 2008-2009 redemption crises. A couple of the cases out of the British Virgin Islands and the Cayman Islands talked about this issue and argued about it more particularly. And finally, fees. Fees can be provided for, or at least the fee structure or formula can be provided for in constitutional documents. And all of these things are things that a prospective investor should look for and a fund manager should think about providing for. We've had lately some discussions with clients about transparency, and this for me seems to be a more recent issue. And it's the investor right to information about the fund's strategy and its performance during the life of the investment. And recently, I've had a case where the investor insisted that the right to information be built into the constitutional documents. There was a lot of discussion about what would be in there, and the manager who wanted to do business with this investor really didn't want to give away a lot of proprietary information. But at the end of the day, we built a fair level of disclosure into the constitutional documents. So I think at this point, seeing that as something that a prospective investor was looking for, I think it's something that funds should think about providing a mechanism for in their constitutional documents in advance of discussions with an investor. Structure diligence. The meaning of offshore in Sao Paulo is very interesting. Typically for me, offshore has meant an island, whether it's Bermuda, British Virgin Islands, Cayman Islands, Guernsey, Jersey, one of these islands. But in structures that I've worked on here, offshore can mean places like the Netherlands, Canada, Spain. In one meeting I attended, Turkey was mentioned. So there are a lot of international investors seeking to invest in Brazil, and they all have their favorite structures. And when you're planning for a due diligence for a prospective new investor, you need to be ready to retain counsel or support in jurisdictions that can be very far-flung. So it's jurisdictional diligence, which will involve then looking at regulatory structure, who is the regulator and what is the reputation of the regulator, and finally the role of the courts in that jurisdiction has to be examined. The role of the courts, I think, is a very important point because on the subject of dispute resolution, during the 2008-2009 crisis, there were some key decisions that came out of jurisdictions like Bermuda, Cayman Islands, and the British Virgin Islands. I put some of the case names up here, and some of you may be familiar with them. They were key decisions involving disputes between investors and funds about how their money was invested, how their entitlement to redeem and receive that money back, and when they were entitled to receive it back and how. And all of this was fodder for a number of very high-profile litigation, which I think at this point, sitting in 2011, we just have to be aware of. Investor and fund disagreed over how they would exit and when, and litigated it. And I think as an investor in a prospective new fund, you need to be aware that this happens. You need to look for inconsistencies between what an offering document says and what constitutional documents say vis-a-vis the right to get your money back. And when looking at setting up a new fund in an offshore jurisdiction, or as an investor looking at the jurisdictions that have been chosen by a fund manager to set up their fund in, you need to have regard to what access you're going to have to the courts at the end of the day in the event you end up in a dispute. And I think that the cases I have mentioned here out of these three particular jurisdictions, each jurisdiction has a final right of appeal to the UK Privy Council. One of these cases, the strategic turnaround case out of the Cayman Islands, actually went there. And this is an important question when diligencing a fund to ask, as an investor, where is my court of last resort? It's not a bad place to end up in London. Other structural issues I'll just touch on quickly. The custodial structure is a very basic question, and that is, are the assets safe? Can they be moved out of custody to a different jurisdiction or rehypothecated? And if so, you have to look at questions like the creditworthiness of the counterparties. In Brazil, the tax structure is important to diligence because there can be multi-jurisdictional issues, tax issues. I think what I have here is a typical tax structure. This is what those of you who work with funds in the U.S. are probably used to seeing investing into Brazil. The foreign investors will invest in an offshore fund where the tax rate is typically 0% or neutral on the distributions to the offshore fund. The offshore fund, for basically to avoid if it's in a blacklisted jurisdiction, the structure that's typically been used in Brazil is to put a U.S. LLC between that fund and the Brazil fund. And then the money flows down from foreign investors into the Brazil fund and then back up, hopefully by way of distributions when the fund has done its thing. But when diligencing a typical tax structure, I've filled in the 0% for the offshore fund because that's typically our answer. But as an investor diligencing a tax structure in Brazil, you have to get counsel in the U.S. and Brazil to fill in the blanks on this chart so that you know that this structure is going to work for you and you understand what the tax rate is going to be at each level. There is unfortunately a degree of uncertainty in Brazilian tax law at the moment, and I've been involved in structuring a couple of funds recently where Brazilian Tax Council have expressed a concern that the typical structure for a Brazil fund that I had up a minute ago, and which is here in its limited partnership form, may not work for Brazilian tax purposes if the offshore entity is managed from an office in Brazil. So I threw in this slide as a diligence item because I think it's very, very important for investors to ask these questions. And whether you're a U.S. investor, as I have on this slide, or from any other country in the world investing through an offshore limited partnership and down through a U.S. LLC into a Brazil fund, you need to ask the question whether there's tax risk of any kind in Brazil with that structure. In recent structures, we've actually set up the offshore company with offshore residents on the board of directors as opposed to the Brazilian manager sitting in Sao Paulo being on the board in an effort to try to mitigate some concerns that have been raised by Brazilian counsel. So I'm raising this today as a diligence point. Compliance issues, again, I think I mentioned that you have to identify the relevant jurisdictions. Many of them have anti-money laundering requirements built into their law, which, if a fund does not comply with, the fund and its officers and directors can be guilty of criminal offenses. In diligencing the fund, you have to identify those jurisdictions, and you need to be sure that the fund has the relevant policies and procedures and an appropriate compliance team for seeing them through. So the compliance issues are also a due diligence issue. I always expect that there will be questions asked of service providers, not only a review of their contracts, but also, if possible, a prospective investor should meet with the service providers, the key service providers, the administrator, the manager, the custodian, and, if possible, the auditors and the lawyers for the fund. And it's good for an investor to get an idea, how is the relationship between those groups of people. Is it a new relationship, or is it a long-established relationship? And I think you take greater comfort from relationships that are long-established, as well as to review their contracts. So, in conclusion, from a legal perspective, what is due diligence all about? I say, unfortunately, it's like going to the dentist. It's a time-consuming and expensive process. And it's an ongoing, continuous process during the life of the investment. But I think it's a vital process in managing risk in investing in 2011. Thank you.
Due diligence nowadays is all about fraud and mistrust. The keywords in due diligence should be alertness and transparency. We see a lot of risk for hedge funds. A hedge fund can collapse due to bad investment decisions. Other risks are operational risk, reputational risk, valuation risk, and so on. Investors are currently dedicating more time and efforts on due diligence, done by themselves directly versus what they did in the past, going through fund of funds and consultants. We see an increase in investment committees with veto power for the investors and investors requiring investment managers to meet more often to align expectations. Investors will place a premium on hedge fund managers that are capable of providing proactive and frequent due diligence, preferably certified with SA 70 or ISO 9001 certificates. From the hedge fund perspective, managers don't naturally want to disclose any competitive edges. The fund manager needs to allocate more and more time on due diligence with a higher frequency across a number of different areas, including on-site visits, meetings, document preparation, and due diligence questionnaires. These additional burdens will require a fund to allocate expensive resources. Consequently, the hedge fund manager needs to come up with a detailed and cost-effective plan for dealing with ongoing requirements of operational due diligence. It's important for the hedge fund manager to recognize what's the concerns of the investors. There are 4 basic concerns. The first concern an investor has is that he wants to know that the fund that he is investing in is investing for the benefit of the investor, not for the investment manager, not for the other service providers. Second concern that the investor has is the assets. He needs to make sure that the assets are safe, are kept in a safe way. The investor further wants to know that upon redemption, the redemption is the exact pro rata amount of the current net asset value at that point in time. At last but not least, the investor wants to make sure that the investment that he is making in a fund is in alignment with the investment policy as outlined in the offering memorandum. An investment manager can prepare to cope with these concerns. For instance, he can get the answers to the following questions. If an investor wants to know whether the fund will be managing the interest of the investor, the first question would be, is the manager himself investing in the fund? If that's indeed the case, then the shareholder, the prospective shareholder, will know that the interest will be managed for the benefit of the investor, since the investment manager is also an investor in that particular fund. Another question could be, are there any conflicts of interest that the investor should know of? Typically, independent directors are involved, an independent administrator. A conflict of interest could be that one and the same company is providing directorship services and administration services. The director should overview the various service providers and evaluate them from time to time. And if it's a company acting as a director and an administrator together, then there is no segregation of duties and there is no clear overview of the director evaluating the administrator. The other concern is that the investor is about assets. The assets should be kept in a safe place. The question that the investor may pose to the investment manager is related to movement of funds to third parties. In order to make sure that the funds are not moved to unauthorized third parties, the investor may require the investment manager to put in place a dual signatory power in order to avoid that funds are leaving the fund unauthorized. And examples there are redemption payments, expenses payments. The third concern of investors is related to redemptions. They want to have their fair share. What they can ask the investment manager to do is to put up an audit requirement. So if a redemption is paid out, that first initial installment will be paid of 90%. And then after the audit has been finalized, the additional 10% will be paid out, making sure that indeed any price changes will be coped with. The fourth concern of the investor is whether the fund will adhere to the investment policy. Typically that's a responsibility of the director who is overviewing the fund anyway. But since the director is only meeting with the investment manager once or twice a year, that's not practical. So other parties involved are in a better position to judge the adherence to the investment management policy. It's the administrator or the investment manager themselves. But from an independent standpoint, the preference is, of course, the administrator. What you can think of is come up with exception reports indicating whether there are investments, outline of the investment policy. And the director needs then to make the decision whether you need to disclose that to the investors or not. If it's important, then it's up to the investors to decide whether they want to stick to the fund or vote with their feet and redeem out of the fund. To conclude, both the investor and the fund manager and service provider must be able to demonstrate that they can properly manage and mitigate operational risk via execution of due diligence. This in order to overcome mistrust. In addition, investors should get comfortable with the fact that various service providers are involved in the fund. They all independently will conduct their own due diligence review, pointing the investor in the proper direction. Thank you.
Hi, good afternoon. I'm going to speak about getting Brazil funds ready for global markets, the SEC, and alternative investment fund managers. Institutions are underinvested in alternative investments, particularly within the US institutions. More and more pensions and endowments are going to increase their allocations to hedge funds, and this is going to accelerate an existing trend towards institutional investors, rather than high net worths, participating in hedge funds. This trend towards institutional investing is leading to the professionalization of the due diligence process. High net worth investors may only really care about the ultimate performance and the bottom line of the fund. And from what I can gather, this seems to be a common experience of Brazilian fund managers today. However, when institutions invest, they're really going to take a long look at a fund and how it's operating before investing. And this may well be a new experience for Brazilian managers. Such investors are really looking for a critical mass in a fund, the performance track record, the pedigree of the investment manager, institutional caliber infrastructure, third-party asset verification, clear pricing policy, effective fund governance, and counterparty risk management. There is also a new depth to due diligence. They are not just scratching the surface. We've seen a trend towards an increased use of specialist due diligence auditing firms, and on-site visits are normal not just for the fund, but for the key service providers, as Alan mentioned. I think where an investor is investing across a border, there's a heightened awareness of these issues, and the investor is even more cautious than perhaps otherwise. So how does a manager respond to these challenges? Well, first, with patience. There's certainly one factor that's increasing the lead time it takes for a new fund to launch or for a fund to land a large allocation. We're seeing a lead time of up to a year being the new normal, as opposed to just a few months from the start of any dialogue, perhaps. Managers need to take the time to prepare and look inside their business and do their own due diligence to make sure that their business and that of their service providers is up to scratch. Can they respond well to the challenges which Peter was just outlining? Managers need to have a robust back office. While there are lots of talented managers, we see a shortage of high-caliber middle office and back office staff, but certainly within the US. This has accelerated the trend to outsourcing these services to third-party administrators within the US. In Brazil, of course, the use of external administrators is already well established, so Brazil is ahead of the curve in that respect. Outside of Brazil, the fund administration market is very fragmented. Managers appointing administrators need to do so carefully, as there's a very wide range of service offerings and service levels. SAS 70 certification is certainly one indication of quality that managers should be looking for when they start their search. SAS 70 has now been superseded by SSAE 16. Not simplifying the acronym there. So that's the new language that managers need to look out for. Managers should also consider if they want to outsource their daily middle office operations as well as their fund administration. There's certainly a trend to outsource that within the US, as the pain of building out an effective middle office operation is quite severe. Moving on to talk about getting ready for the SEC, I'm going to take a liberty here and talk more broadly about getting ready to deal with the US government. There is certainly more legislation, more regulatory scrutiny, and funds need to have a best practice compliance program in place. Compliance needs to be high on the corporate agenda, as even a relatively minor infringement will really hamper the ability of a fund to raise assets. For funds investing in the US capital markets or dealing with a US custodian or prime broker, they will be required shortly to have a new dialogue with the IRS. This is due to FATCA, which is the Foreign Account Tax Compliance Act. FATCA was passed in 2010, but is raising, I think, high on everyone's agendas currently, the implementation date being 2013, 1st of January 2013, which is not that far away. FATCA is a significant change for offshore funds. The Act is aimed at finding tax abuse by US taxpayers. So you wouldn't think this would be a problem for offshore funds or for Brazilian funds. However, FATCA creates a new major tax reporting and withholding regime, and it effectively forces compliance with that regime by way of an extremely punitive withholding tax, 30% of gross proceeds for non-compliance. So funds will simply have to comply in reality if they wish to continue to invest assets within the US. This means there will be a new, extensive compliance obligations, including entering into an agreement between the fund and the IRS and collecting and recording more information about the investors in their funds and certifying that the fund is in compliance with FATCA. I don't want to go into more details on FATCA, but suffice it to say you should be talking to your service providers about it now. There is significant preparation to be done, including potentially IT changes to manage the new information requirements, which could take some time to deploy, so this is a conversation that ought to be happening now. Coincidentally, the new rules for FATCA are going to be published a week today on May the 11th, and this is going to be the last round of publication of rules, I think, and it will bring some clarity to the requirements. The last word on FATCA is that I think the world will be watching it with some interest, and if it's a successful regime for the US government increasing its tax take, I can imagine that similar legislation will be coming out from other countries in time, probably starting with the EU. And speaking with the EU, finally, just a few words about the AIFM directive, the Alternative Investment Fund Managers Directive. This creates a European-wide, EU-wide passport for fund marketing purposes. The legislation was passed after considerable debate in, I think, November 2010, and the legislation that was passed was considerably watered down from prior drafts. However, there will still be an impact on managers marketing non-UCITS funds within the EU, i.e. a Cayman or BVI fund. There's some enhanced due diligence requirements and some new borrowing limits, amongst other issues. In terms of timing, there is no change until 2013. Until 2013, the existing EU laws will continue to be applied country by country. So a fund marketed in the EU and Ireland, for example, will be subject to the regimes of the EU and Ireland. After 2013, the passport scheme will be in place. However, this will only be for EU managers or EU domicile funds. So for a Cayman or BVI fund marketing there, the existing regime will stay in place a little bit longer. After 2015, the passport regime may be extended to non-EU countries. If so, it's anticipated that BVI and Cayman would be eligible countries to join the passporting regime. Overall, in terms of choosing a domicile, it seems that the AIFM directive will not have a major impact in terms of most managers' decisions. Thank you.
Thank you very much. I would like to open the forum for questions from the audience. Please, if someone has a question, could you please raise your hands? Okay, so I have, as a matter of fact, a question. I think that when you talk about due diligence, being a fund manager, we pass through so many due diligence. I think that the aspect that we see that is sort of like a problem is that sometimes you find a due diligence that's very well done, but there are a lot of hidden problems behind the due diligence that are difficult to uncover. How do you guys push for that? How do you try to uncover things that you may receive a very perfect due diligence in place, but you may uncover like kind of hidden problems on that due diligence? What's your technique for that?
I can say from a legal perspective, what we look for is inconsistencies. Mm-hmm. And one of the cases that I had up on the screen a few minutes ago actually arose, I think, from an inconsistency between the offering document and the constitutional documents. So where we start with the due diligence process from a legal perspective is to look for those kinds of inconsistencies. But that theme runs through the entire due diligence when we're involved. Not only are we looking for inconsistency between what the offering memorandum says and what the constitutional documents say, but we're also looking for any inconsistencies in what we hear from the service providers. So really, that's the best way I can describe what we're looking for. That's the only way and the best way, or the most common way to uncover issues that even sometimes the fund doesn't realize it has.
And I would just add to that, not to answer your question on how to uncover it, but what we're seeing from our clients or prospective clients is the use of specialist firms with great experience in due diligence. And the typical visit now for us as a fund administrator might be 2 or 3 days on site with us, whereas maybe 5 years ago the typical experience would be maybe a 1-hour due diligence call. And before the visit, we tend to be completing extensive 100-page documentation, DDQs for them, detailing what our procedures are. And our experience of these firms is that they're very effective. And I think the firms are managing their risk by using those providers.
Yeah, I think that the on-site is very important anyways. Also, another question I think that you mentioned about managers. You mentioned about the issue of boards, in terms of like constitutional board. Could you clarify if the manager is a minority in the board, or if it's a majority in the board? What are the different issues? Because you may have a situation that you have an independent board and you have a manager belonging to that board.
This becomes a really important issue sometimes for investors and also for the manager who doesn't want to lose control. The tax issue I was referring to is an issue of control. And the general anti-avoidance rule in Brazil for taxation could potentially look at this from the perspective of, if control is here in Sao Paulo, then every entity in the chain, in the multi-jurisdictional chain, is subject to Brazilian taxation. So there then becomes a dialogue between the manager and the investors as to how you can implement a board of directors at the offshore level that the manager is going to be confident is not going to try to change his strategy or somehow otherwise interfere in the way he carries on his business. And what we came up with in one case was a situation where the board of directors was comprised largely of a majority of independent directors. These are people who, some were professional independent directors, who there are firms offshore that provide that service nowadays. And others were business people, Brazilians living in the United States, for example, familiar with the manager, who then all constitute the board of directors together with the manager's people in minority. A board that's constructed like that and meets offshore or meets anywhere outside Brazil it's not completely bulletproof, but it's the best way to address the concern I mentioned. And it's much, much better than just having the manager and two of his best friends from Paulista Avenue on a board of directors of, say, a Cayman company or a Delaware, being the managing members of a Delaware LLC. So it involves give and take, but at the end of the day, to overcome the control issue, it would have to be a majority.
Yeah. The reason also I say that's because I see, at least for the past 3 years, a push for all investors that the boards are independent. So it's very clear to us as fund managers that everything we do has to be with independent boards, because so we do our business of managing, but the board is the decision power of the activities of the management company. So in that regard, I think that the trend is definitely for independent boards.
No, absolutely. But in my practice, I found that not all Brazilian managers have bought into that, and they are yet to really appreciate the value of it. I think as time goes on and we see more investors expecting it, they will quickly appreciate the value of having an independent board.
Okay, so I don't know if there are more questions from the audience. All right, thank you. Let's adjourn. Thank you very much.
Thank you.